So India is very clear. I mean, I think it's almost beyond debate that this is the most attractive longer-term structural opportunity in Asia and arguably in global emerging markets. Trend economic growth is going to be in the mid 6% level. We're looking at 6.3 next year after 6.4 this year, and really kind of on that sort of mid-6 trend. That in turn results in a nominal GDP growth backdrop of close to 10%. And the earnings delivery against that backdrop is going to be in the mid-teens. We're looking for about 15% compound growth over the next few years. And indeed, India has a track record over the last decade of delivering about that. And that indeed is what has powered the market and has done well. Now, we've held off on, we've had it overweight for a long time. We downgraded about a year ago because the market at that time was trading at 23 times earnings and nearly 100% premium to the rest of the region. So our mantra at that point was, look, love the story, we just don't like the price. Now that we've had the market up 6% this year, while earnings have grown 17%, you've had some moderate compression of that forward PE multiple. So it's not super cheap, but it's less expensive than it was before. And our sense was that, look, even though there may be some near-term concerns about potential market volatility into the elections, which are coming up early next year for the Lok Sabha, the lower house of parliament, that strategically we want to be emphasizing the longer-term opportunities for India, and that's why we decided to move it up in our outlook report, which we just published. For Thailand, just quickly, we had a view on ASEAN in 2022 that it looked more attractive after 10 years of underperforming the rest of the region. And indeed, ASEAN did do well that year as a function of recovery from COVID and positive monetary policy cycle, which is good for the banks, which are very largely represented in many of the indices, particularly in Indonesia. We actually took that view off the table in 2023 this year, and in fact, ASEAN has underperformed. So with that having happened, we think the opportunity is ripe for taking a some more targeted and constructive view on some of the markets. And I think Thailand is one that stands out to us for a couple of reasons. One, the economy will accelerate next year after having been suppressed this year because of political issues. The Thai baht is our favorite currency within ASEAN, and we get a little bit of a delayed tourism recovery boost from China outbound travel, which is something which is very consequential for Thailand's economy. So we think that earnings will recover to about 14% growth next year, which is better than our sort of weighted average of 9% for the region. So all those combined say to us, look, maybe it's time to take a little bit more of an opportunity in Thailand, especially since the market's down, roughly 15, 16% this year. So those would be the quick reasons for those two.
Yeah, absolutely. Yeah, the Bangkok SET has been a significant underperformer this year. But overall, would you classify 2024 as potentially a tricky year for investors? There have been some years in the past where basically you could take a dart and you could throw it at the board and you hit a bullseye. But does 2024, even if we have a tailwind of central banks, moving towards easing policy as opposed to tightening policy, do you think it's going to be tricky still?
Well, that's exactly the word we used in our report, and the answer is yes. And I think it's important for investors to understand that the macro backdrop has a number of key themes and key characteristics. And so we're going to see, we think, still good. We're above consensus in terms of our economic view, but growth is going to slow. I mean, China, as I mentioned earlier, 5.3 to 4.8. The U.S. will slow, even though we're well above consensus. We're still going to slow somewhat. So, number one, we've got some moderating growth. Number two, we've got an environment of high for longer interest rates. Because we're above consensus on growth, we're also above consensus in terms of when we think the Fed will start to ease policy. We think it's going to be the fourth quarter of next year rather than the second quarter. That in turn leads to a strong dollar view. And then we also have a pretty active political calendar. It's still heightened geopolitical tension, even with the Biden-Xi meetings, which will take place this week. And then lastly, we've got a number of the macro challenges China faces, which we've written extensively about. So you roll that together, and it suggests that it will be a tricky market to navigate. We think that Asian markets have sold down and priced a good deal of that in, but really it's going to be dependent upon the delivery of earnings. And that suggests to us from the environment of maybe about 10% overall potential returns with some potential wide variance around that. So that's why we think it'll take a little bit of navigating, and why our key message is focus more on the alpha, the more specific opportunities, as opposed to the broad-based beta ones.
Just very quickly on India, Tim. I mean, don't you worried by the current level of valuations there?
We do, Tim. I mean, in round numbers, India is just a touch below 20 times earnings. The long-term mean is sort of high teens. about 17. Last 5 years has been a little bit higher. So we do, in our forecast return, we expect some derating of the market down to about 18.5 to 19 times earnings. It could drop lower than that, but we think that in the current environment where India really has been delivering very, very consistent profit growth, and given that that's still kind of a scarcity in terms of our global view, we think that'll be something that investors will be attracted to. Additionally, we think there will be policy stability, and on top of that, there's the core underlying growth that I just mentioned previously. So, we think that there will be some moderate derating, but not enough to invalidate the potential overall delivery of kind of low to potentially mid-teen price returns, which we think compares favorably relative to our views for other markets.